Good afternoon, everyone. Welcome to the Provider Relief Fund update presented by Eide. My name is Amanda O'Brien. I will be your webinar specialist this afternoon. Should you have any technical issues, please utilize the chat function and I will address them as soon as possible. Today's presentation is being recorded and will be available on our YouTube page in a few days. Also, a copy of today's presentation will be sent out as part of our follow-up process. If you have any questions for our presenters today, please utilize the Q&A function and we will address as many as possible. And with that, I'm going to turn our time over to our team.
All right, sorry about the technical difficulties, everyone. Having a little trouble, Amanda, with the slides here.
No worries, give me 1 second.
There we go, perfect, perfect. My little button was not coming up. Thank you everyone for joining us today for the Provider Relief Fund update. For those of you that have been involved or watched our webinars in the past, you may notice that we don't have Tyler here. Don't worry, he is still around. He hasn't completely given up on the Provider Relief Fund, but we did let him take a week of vacation, so he's off with his family at Disney. So I'll be looking forward to having him back and joining in on the fun next time. But with me today are some other members of our Provider Relief Fund team. So my name is Ashley Brandt-Duda. I'm a partner with Eide, joined today by Braid Schweitzer, Ryan Ashland, Catherine Johnston, and Molly Key. So as you may have seen with our other webinars, and anytime we're talking Provider Relief Fund, we always have to add the disclaimer that the information that we are presenting today is current as of, we have here June 7th, which is technically yesterday, but I'll tell you it's current as of about a half hour ago when I checked the website. But as we know, always things are constantly changing when it comes to the Provider Relief Fund. So please just be aware, be looking and watching for updated guidance. So the agenda for today, when we initially planned to do this webinar, it was about a month ago, we had started talking about it. There were a lot of rumors out there that there were going to be some changes to the Provider Relief Funds. And so we were really hoping we could give everyone a really good update and talk about all of the changes that HHS was coming out with. And really, HHS has been remarkably silent since January and really just has not provided a lot of true guidance updates. So really what we're going to do today is really just talk through some of the different areas where we are really seeing a lot of questions, a lot of discussion happening. And so hopefully, even though we don't have a lot of really new information for you, hopefully just still some items that can provide some value as you're working through and determining your Provider Relief Fund reporting. And so we'll give you just an overall status update, and then we'll talk through some specific key areas, lost revenue, the concept of reimbursement from other sources, because that's one that HHS has had throughout all of their guidance, but again, just pretty complicated to determine exactly what does that look like. We'll talk about some considerations around capital projects, talk a bit about compensation expense, including bonuses, retention payments, that type of thing. And then just overall, we'll have a discussion on where do you go from here? So as far as an overall status update, as I mentioned, HHS has been quite silent since January. They issued their last post-payment notice of reporting requirements on January 15th of 2021. And so prior to that date, they had issued many versions of this. So please, if you have one saved down or printed off that you've been using, please make sure that you have the January 15th, 2021 version, as that will be the most recent. Also, what they have said is they've opened up the reporting portal for registration, but that the reporting timeline has been delayed. And so one of the big questions that's out there is, okay, delayed to when? Because I know everyone is getting antsy thinking that they're going to have this report that suddenly comes due. So that's one of the big questions, really hoping that we hear from them on when that reporting is going to take place. And then as of today, the official deadline for the use of funds is still June 30th of 2021. This is another area where we're hearing out there a lot of rumors that this will be extended, and really just knowing that there are still provider relief funds out there, most of which came through the December stimulus bill, that there's still a lot of provider relief funds that still actually need to be distributed. So hoping that timeline is extended, but at this point, it is still currently at June 30th of 2021. So now I'd like to turn it over to Braid to talk a bit about some lost revenue considerations.
All right, thanks, Ashley. Get rolling to this slide here. All right, so lost revenue. As you hopefully know, there are 3 methods that HHS has approved so far. There's option 1, which is really option 1, option 2 are fairly straightforward. So option 1 is looking at your calendar year 2020 to your calendar year 2019 actual revenue. So fairly straightforward. Number 2, option 2, comparing your 2020 calendar year to your 2020 budget. And that would be if your budget is approved by March 27th of 2020. So that's kind of the magical date in all of this. And option 3, any other reasonable method. So kind of leave it wide open as far as what that third option looks like. So before we get going a little deeper into the options, I'm going to just bring up an FAQ that a lot of people have asked and HHS clarified back in December. It's about, should providers be including any fundraising revenues or grants, or maybe any other revenue that they've received? Should they be including that in their provider relief patient care revenue number? And HHS mentions that these other sources should be included if they are used to contribute to funding patient care services. So if those funds you're getting are used to fund patient care services, you will want to, that jumped on me, want to use those. Let's see, I'll just keep going here. So option 1, comparison of your current year revenue, so 2020 current year to your 2019 actual revenue. And this is required to be reported both years by your major payer categories, and then whether it's your standard basis of accounting, whether that's cash or accrual. So if you are a fiscal year end that isn't a calendar year end, you might have to shift things around a little bit to grab just the calendar year reporting. Option 2 here is your comparison to budget. So this is looking at your 2020 actual compared to that 2020 approved budget if it was approved prior to the March 27th, 2020 date. Again, that's the key date there. And it must be, you must submit an attestation from a C-suite individual regarding said budget that it was approved prior to that March 27th date. So again, if you aren't a calendar year end, that may pose a few issues. If your budget really only goes through June or maybe September, what does that look like for you? You may wind up not being allowed to use this option 2, and I'll touch a little bit more on that in option 3. Option 3, so alternate methodology, that any reasonable methodology. There's no real clarification on what reasonable means. So this is where we can get our creative juices flowing on where some avenues that we can look to try to reimburse or get as much lost revenue calculated as possible. Some things that you'll need to submit are the description of the methodology. So whatever methodology you choose, you'll want to make sure that you describe how it is. You want to include any calculations of those lost revenues. How are you arriving at whatever methodology you are using? How do you get to that number? Then an explanation of why you feel as an organization that it is considered a reasonable methodology. And again, if you'll need a description on how that lost revenue is attributable to the coronavirus and not a loss due to something else. And now option 3, it's not as cookie cutter as option 1 or 2. So HRSA mentioned that there is going to be an increased likelihood of an audit by HRSA. Thankfully, they said if your option 3 is not deemed reasonable by HRSA, they are giving you essentially a 30-day notification or grace period to use option 1 or option 2. So there's a little leeway there if your option 3 gets rejected. Now I'll kind of get into the meat of what the lost revenue, some examples that we've been hearing from clients or internal discussions at Eide Bailey on where are some ways that we can maybe try to see how we can maximize our lost revenue. So the first one here, comparison to a forecasted calculation. Maybe your organization runs some sort of trend analysis or projections to say, here's what our revenues were for 2018, here's what they were for 2019. Based on that trend analysis, here's where revenues should have been if 2020 was a normal year. Are you able to quantify what that revenue should have been, and then comparing that to what actually happened in 2020? The next two here are maybe changing the time period. Again, option 1 and 2 is really that calendar year, January to December. What happens if we change those time periods? So I would say middle of March through to April 1st is maybe the beginning of COVID in America, to where you maybe carve out and exclude January through March and just use April through December for both years and use that as your time frame, because January through March, maybe there was no impact from COVID. Or specific time periods. I'm in Fargo right now, so North Dakota saw our big spike, let's say September through December. So maybe you take those last 4 months of 2019 and compare that to 2020, and that's really the portion of 2020 that you were truly impacted by COVID. The other rest of the year, you maybe were a little bit, but not to the extent that the September through December timeframe posed as far as COVID cases go. Some other things to think about: adjustments for identified changes. Maybe you expanded a service line. Maybe in 2020, you brought on a cancer center or something, to where, let's say you carve that out of your analysis, because there's no comparable data from 2019. So if you carve out the cancer center or whatever service line you may be added in 2020, you can get a little better apples to apples comparison to say, this is what we feel is a reasonable methodology in using kind of the true year over year data that stayed consistent. Maybe you're able to quantify your price changes or reimbursement increases that happened during the year. Let's say your rates went up X%. Are you able to quantify that rates went up 5%? So if we didn't get that 5%, here's what our revenues would have been, and then comparing that to 2019 to say, all right, because of our rate increases, if we didn't factor those in, our revenue would have been down by X dollars this year. So maybe going that avenue. Revenue cycle improvements. Maybe 2019, your revenue cycle team had some turnover to where you saw some bad debt expense increase or administrative adjustments, things like that, to where in 2020, the ship kind of rebounded and your team is kind of working together perfect, and you have the turnover, you don't have that turnover anymore, which is great from your organizational standpoint. That's what you're hoping, that revenue cycle team is kind of churning things out how you want them. But from a lost revenue perspective, maybe that negatively impacts you since your revenue increased this year. So if there's a way to somehow quantify, this is what our revenue cycle improvements increased our patient service revenue by, that might be an avenue to go down as well. Analyzing specific service lines. I know I talked about the cancer center earlier, but maybe this time you carve out a specific service line and just analyze that. So let's say your outpatient surgery this year took a massive hit because you weren't performing as many surgeries, trying to keep people out of the hospital to keep your staff or other patients safe. So the rest of these service lines were status quo, they were pretty consistent, but your surgeries decreased by X dollars. Maybe it's an opportunity to just look at said service line or service lines if some of them were negatively impacted. And here, coming back to that option 2, that partial year approved budget. So let's say you're a September 30 year end and your budget was approved before that magical date of March 27th, but it only goes through September 30th. So you don't really have the calendar year, full year aspect to look at. So maybe with your approved budget, you look at the first 9 months of 2020 and compare that to your approved budget that was already in place as of March 27, 2020, to maybe capture that timeline, depending on what your fiscal year end is there. Lastly here, just some closing thoughts, probably a theme you'll hear throughout the entire presentation, that documentation is really the key to all of this. The more documentation that you guys can keep and support your calculations and standpoints, the better off you'll be. So if you can have as much financial statement support and calculations or board minute discussions with the board and approvals of, we're going to use this methodology, or we approve the budget on this date, which meets that March 27th date. And then really any other support that you have, the more that you have, the more beneficial it will be for you in the long run. As Ashley mentioned, hasn't been much guidance from HHS recently, but if any of you remember back in September and November, things seemed to flip overnight as far as what was considered lost revenue. The next day it wasn't, so you had to kind of scramble and try to figure out what the next strategy was. So I would say if your organization can be nimble and be able to take on any new guidance as it comes out, hoping it comes out relatively soon, just knowing that there may be some changes. Lastly, as an organization, I would say discussions with your board as well to maybe have, if you're going to use option 3, have option 1 and 2 calculated as well, just to say, okay, if option 3 does not work out in our favor and HRSA rejects it, we at least know option 1 is going to provide this much and option 2 is this much. So you should have a floor of some sorts to say if option 3 gets rejected, option 1 at least provides us X, $1 million for option 1. So we at least have that to fall back on. So with that kind of concludes our lost revenue. The rest of this will be, I'll turn it over to Ryan here shortly, going through expenses. So I'll let him take over the reimbursement side of things.
Thanks, Brad, everyone. Hello, everyone. I'm Ryan, and I work in the reimbursement department here at Eide Bailey. So I will be going through, obviously, the reimbursement section of our presentation here. All right, we're really going to cover 2 main areas when we talk about reimbursement. We're going to talk about reimbursement from other sources. And then for those of you that have some cost-based reimbursement, we're going to spend some time on that section as well, more of the critical access, rural health clinics, those types of things. So I think the key part was starting point of the reimbursement section is when you're doing your analysis to say, okay, I have this much lost revenue, I have this much expense I can quantify. You want to make sure you calculate and quantify all of those dollars, and then what other sources do I have to subtract those dollars from, so I can get down to the net amount that I can claim against my provider relief fund. So make sure you know all of these various dollars you're coming in. We've got them all accounted for in line up, so we're really not double dipping anything. It's kind of a key theme of the guidance that we sent out so far. And also make sure you're keeping track of not only capital and expense items. We cover both of those areas. Some examples of reimbursement from other sources. I'm sure many of you have seen some of these things from your day-to-day accounting and the dollars you receive, but obviously any grants you're getting from the state, hospital associations, any private sources, making sure you're keeping those as part of your analysis. Another big one that I'm sure impacts a lot of you is the payroll protection program. If you've already submitted your application for forgiveness, any of the payroll dollars that you use to count towards that program, you can't then count against your provider relief fund. So if you haven't submitted that forgiveness application yet, and you're going to use a 24-week period, you more than likely will have enough dollars to get full forgiveness if you have that full period. So you might be able to take and say, I'm not going to include all those dollars in my PPP application for forgiveness. I'm going to hold some of that back because I could truly count those against the provider relief fund. So maybe some analysis you can do there. Most important point being only count it once. Same for the employee retention credit, handling it the same way. And there's other examples as well. Just point being, make sure you get all of these into your analysis so you can come up with a true net number that it can count against the provider relief funds. One other example of reimbursement from other sources that we want to talk through is payment on patient accounts. So if you're doing COVID vaccines or you're doing testing for COVID, you can very easily say all those expenses are related to COVID, and they are. You just got to be careful of, okay, if I'm billing those into someone's insurance and I'm getting payment on those, I got to make sure I don't include those. I got to make sure I subtract off the patient or the insurance payment and or patient payments. So in some of these cases, you may be getting more than what your actual cost is when you do this analysis, saying, okay, here's my cost of providing that COVID test. The insurance paid me X or Medicare paid me Y. I don't really have a loss on those services. You maybe can calculate a loss on some Medicaid or some uninsured that you weren't able to get paid. So those would be ones that you could definitely use the methodology of saying, okay, here's my cost, less what I was paid, and I can claim a net amount. But maybe some of those other commercial ones, you won't have as much opportunity there. So just keep that in mind as you're going down that pathway of calculating any patient payments on services that they get or from insurance companies. One point to think about in here, though, is if you're testing employees and you're not billing those, you're just writing those off, those costs of testing those employees would definitely be something you can include, and there would not be a reimbursement aspect to consider there. So that's kind of our other sources. At this point, I've hopped into a little bit more on the cost-based reimbursement. Obviously, there's critical access hospitals, rural health clinics, and maybe some state programs that are applicable here. Probably doesn't hit everyone, but a lot of folks on the call today. And we need to treat the cost-based reimbursement similar to the other reimbursement sources I just talked about. We want to make sure we reduce these amounts so we claim the net. Unfortunately, there's not a lot of clear guidance on how to calculate the amount of cost-based reimbursement that we need to subtract off. So in the next couple of slides, I'll go through some examples and maybe give you some thoughts of a way you could estimate this and kind of calculate it on your own as we go forward so you can come up with what's a true net amount. The first thing we want to think about is how do we calculate this? Is do we do this at a department level, or can I just do it at a top level from our organization? There could be pluses or minuses to each method. The challenge might be at a department level is, am I able to identify all of those costs at a department level? So an easy item is like PPE expenses for gloves, masks, whatever it might be. How are you going to allocate and identify the departments that use those? So either option is potentially feasible. Might be hard to get all of the items down to a department level. So in the next couple examples and items I'm going to talk about, I'm going to just concentrate on a top level calculation. And on the second set here, we have a couple options that you might be able to consider when doing a top level calculation. Really is using your cost report if you're filing one of those, and having your consultant you use to help prepare your cost report actually do an adjustment in there and figure out how much of my net reimbursement really going down or up because of that adjustment. That's the example I'll go through later on. I think that's probably the recommended way I would do it because I think it gets the most accurate method. But there's also another option you consider if you want to try to do a little bit of an easier estimate is you could take your cost report, take your Medicare cost, divide it by your total cost and say, okay, that's how much Medicare share is of that. So that might not get you exactly amount, but I think it would give you a good estimate as a starting point for how to calculate. Using your Medicare payer mix as a percent to calculate, I wouldn't advise doing that because it's more than likely going to overstate the amount that you have to reduce the funds by. And same goes for the cost to charge ratio. That's kind of a standard cost report lingo. It's really not applicable to this scenario, so we wouldn't recommend using that option either. So if I keep going on an example of a top level calculation where I'd actually use your cost report, let's just say hypothetically we do $1,000 adjustment on your cost report, we recalculate the settlement and your cost report So that 250 out of $1,000 or 20%, that's really the amount that the cost-based reimbursement is covering. You would have to reduce down the amount you can claim by that 25%. So if I take that $1 million of expenses, reduce it by 25%, it'd come up and say I'd have $250,000. I'd have to reduce it by, my net would be the $750,000 that I would have that I could count against the provider relief funds. Unfortunately, there's one more thing you need to think about when you're doing that calculation. You almost need to gross up the calculation to determine how much do I really need to have to report. So again, I'll use that similar examples and saying, I've done my calculation of my provider, all the dollars I've received for the provider relief fund. I've taken off my lost revenue. I've taken off all my reimbursement from other sources. I have $1 million that I need to be able to quantify for expenses. Well, if I'm cost-based reimbursed for all that dollars, I would need to gross that up under the hypothetical 25% scenario here to say I need to identify $1.33 million of expenses. I'd reduce that by 25%, and then I'd have my net $1 million to report up against the provider relief funds. You need to make sure you can document and have a support for the 1.33 million, but you'd only be able to count the million. So really, most important thing, do the gross up, figure out that percentage reimbursement, and that will help you get down to the net that you'll be able to report. And that's kind of the key point out of all of this cost report section, is making sure if you're subject to cost-based reimbursement, you're including this in your calculations, because you don't want to get to the end and not have this part of your scenario and have a potential payback situation. So make sure it's part of your calculation. If you have questions on how to calculate it, whoever prepares your cost report could certainly assist you with coming up with an estimated percentage. And I touched on a lot of expenses and so forth of how to calculate the reimbursement impacts, but we want to make sure we also consider them as part of the capital projects. And that's going to be part of the next section when we go over capital projects that Catherine is going to take over. So I will turn it over to her at this point.
Thank you, Ryan. So looking at capital projects, so this is one of the kind of main categories where we were told provider relief funds could be used to purchase equipment or do certain projects with your facility to meet the terms and conditions, which are prevent, prepare for, treat coronavirus. With all of the potential questions that could be out there, they gave us an entire 2 question and answers. So let's look at those 2 questions and see what we can kind of get from those answers. The first one, when purchasing capital equipment, can the entire amount be claimed as an expense, or can we only use the 1.5 years of depreciation that was incurred during the period? So one of the things I want to point out here, these answers are coming from HHS from the viewpoint of how you are reporting your use of these funds, not how they should be expected to be reported on your books. So the answer here, even though the question is very much about capital assets, also goes into inventory. And what this kind of tells us is the entire cost can be claimed as long as you're meeting the terms and conditions for purchases of equipment and inventory. So this allows for you to make some bulk purchases of inventory that may hit your balance sheet and sit in supplies for a while until you use them and expense them. So just be cognizant of that. When you see fully expensed, that means you use those funds from the HHS standpoint. That does not mean you have to fully expense them on your organization's records. And then some of the examples, which I'm sure you guys have already seen before. The second question deals with capital projects. So if you are making upgrades or different projects, and very close to the first one, the question addresses, can I only claim the depreciation expense? And the answer comes in and says, no, you can claim the entire expense as long as it is under the terms and conditions of the fund that you received the money under. So depreciation is brought up a couple of times here, and we'll touch on that in a minute, how that is considered. But again, the main purpose or the main focus of both of these is the overall intent, the use of the funds, if the project, if the purchase meets those terms and conditions. So looking at some main takeaways, like Braid noted, documentation is number one. Both of the questions, like we said, your project, your purchase must meet the terms and conditions. So what do you have that can show that? I have no pre-approval process here, and that is saying that there's nobody at HHS, at HRSA, that you can go to and say, hey, this is what I want to do. This is why I think it qualifies. Can you give me the green light? That's not going to happen. So you have to make that determination on your own. Now, you should still follow your organization's policies and procedures for, undergoing these projects, making these purchases. So if that requires board level approval or department approval, make sure you follow that process, but it's really going to be a determination at your organization's level as to whether or not your project qualifies. Some of these, when you just put it on your report, they're going to be no-brainers. If it's ventilators, if it's expanding the ICU, something that is already written out there, that's great. But some of these just on the surface may be kind of questionable. An example, I was recently touring a facility and they were showing us some of their projects they did. And one of them was, hey, we remodeled our cafeteria. So just seeing that, okay, how does remodeling my cafeteria help with preventing or preparing for coronavirus? Well, when they walked us through it, it turns out the way that their cafeteria was previously laid out, the design very much kind of bottlenecked people and forced everybody into 1 to 2 smaller areas of the cafeteria and didn't fully utilize the space that they had. After they redesigned it, it had a much better flow and allowed for better separation of people to go through the cafeteria. So that makes sense, but you have to have the documentation ready for that. A lot of things you can do, pictures, here's a picture of how it looked before. These are the changes we made. This is how it looks now. Documentation from your clinical leaders of why this makes sense. Articles that may be out there. If you purchase a specific piece of equipment that is maybe not listed, maybe the vendor provided you with something that said, hey, look at the functions that we have on this that will help you, prevent, prepare, treat. Keep that. Also, any determinations you made based on the FAQs that were available at the time of determination that you can refer back to. Gather all that documentation now, kind of make those calls. I anticipate some of these questions will be answered, but I promise you a lot of them will not. So your organization is going to have to make the call on a lot of these of this is why it qualifies, this is what I based on, here's my backup. Make sure you have that. Basis of accounting, I know I hit this really hard with just because it's an expense there doesn't mean, on your reporting, doesn't mean it needs to be an expense on your P&L. Follow what your organization does. The flip side of that, just because you buy something that says, this is qualified equipment under the Provider Relief Fund, if it does not meet your organization's capitalization policy due to cost or, the project for whatever reason, then expense it. Treat it on your general ledger as you would before. It does not have to match what you report to HHS for as expenses. And then the third tip here, we're going to kind of come back to what Ryan said and also back to the depreciation that I brought up earlier and give a little more attention to our critical access hospitals. Make sure that you're reducing amounts claimed by other funding sources. So we talked about, PPP proceeds. Maybe you got a SHIP grant that was specifically for equipment or, donations of masks and gloves. Don't double dip there. But also, as we go back to the depreciation, If you are a critical access hospital, you know you can expense this entire project. You know that you are going to claim that expense on your cost report. You know that Medicare is going to reimburse a portion of that expense for you. So how much of that future reimbursement do you need to offset? Before you get too excited, the answer is we don't know, as most of this is. So I want to kind of talk through a couple of broad concepts. These, full disclaimer, going back to the beginning, these are not examples given to us by anybody. These are not answers that are out there. These are kind of concepts. These are positions that could be taken, and I'm going to kind of take the extreme of both ends here. So the first one, I'm calling the covered period expense. Again, not a real thing, just made the name up for the slide. So this, what I'm calling the covered period expense approach, would be the more aggressive approach. This is saying that one second. So you know that you have, or you can claim the entire amount that you spent on this purchase, but you are only going to report the depreciation expense for the covered period. You are only entitled to the reimbursement for that covered period. Are you entitled to future reimbursement before you've seen any future Medicare patients? So until you've treated these patients, does Medicare really have an obligation to reimburse you for seeing patients that you have not yet seen? Is there some logic behind that theory? Absolutely. Will HHS agree with it? We have no idea. This really has to come back to your organization, your comfort level, what, the risk that you're willing to take, which is that these expenses may be disallowed. So the opposite end of that spectrum would be what I'm calling the total expense approach. That is saying that I anticipate that I am going to receive future reimbursement for the entire amount of depreciation. So I need to go ahead and offset that entire, reimbursement against the cost that I expect to receive from the beginning. Again, we don't know which one is right, which one is wrong, if we will ever get the answer, or, those are not the only two options. Like I said, those are kind of the high and low end of the spectrum. If you feel you can justify somewhere in between, kind of up to you at this point until we get more information. So, while again, we think some of these will get clarified, it is very likely that most of them will not. So think through these situations in advance. Don't wait for the guidance to happen, because it's not going to happen in every single situation. So look at your individual projects, your individual purchases. What do you feel you can support and why? Gather your documentation and have that ready. So now we're going to move on to a couple more FAQs on salary, and hopefully Molly can give us some more definitive answers there.
I cannot guarantee that, but I will try to clarify here. So, like Catherine said, we're going to move into compensation expenses here. Oh, missed one slide here. Okay, so we're going to start with a couple FAQs. I have just 3 FAQs in the beginning here, and then we're going to move into really some examples or some kind of probes to get you thinking on how to utilize these funds here. So way back in the fall here, back in October of 2020, an FAQ was released basically stating high level what can be included in these salaries and compensation expenses. So the focus here is that bolded font that says you can include full-time and part-time employees, that contracted labor, and then if you have any temporary workers that are coming in. I did add on the bottom here a second bullet point, keeping in mind that there is that cap of the executive level 2 expense, which is up to that $197,300. I will also point out that there is no requirement in the FAQs that the salary needs to be patient-related employees. That is not a restriction on that. So this next FAQ is very long here. I won't read through it, but I will touch on the high points. This really is further clarification on that salaried employee. It specifically addresses director level, but really keep in mind that this is likely alluding to salaried employees, asking for that time that they're spending on COVID-related meetings, trainings, things like that, that they would have been spent on other typical day-to-day tasks. Can we allocate that to the provider relief funds? What the FAQ does say is that it may be allowable with kind of two exceptions here. One, that of course it hasn't been reimbursed by another source, so that double dipping aspect of it. And two, that you're not allocating more than one full FTE, which should, I think, be common sense on that side of things. The last one here that I pulled out is from December timeframe. And this really is focusing on more of the benefit side of it. So those additional expenses that you might be incurring in that compensation expense amount. So they specifically point out that hiring bonuses or retention bonuses are eligible. Maybe you provided childcare or gave transportation stipends or parking expenses, maybe things like that, temporary housing. The key thing here is at the very end of this answer is that they need to be newly incurred after that declaration of the public health emergency, and that they truly were needed to secure and maintain your employees. I do want to circle back on that first one there of the bonuses. There has been a lot of conversation on giving out, let's call them hazard pay bonuses. I would almost steer you to use a term more along the line of a retention bonus versus a hazard pay bonus. You want to be careful with how you term those things because of additional taxes or rules or regulations. So if you are giving out bonuses to make sure that you can retain your staff with staffing issues, make sure to call those retention bonuses. One other thing on bonuses, if you give out yearly bonuses every single year, that in 2020 cannot be considered just a COVID-related bonus in the current year if you have consistently given these out in the past. So keep that in mind. It needs to be that newly incurred expense. So similar to how Catherine had kind of two ways of looking at that depreciation expense, we have a couple ways that you can look at the compensation expense or benefit expense allocations here. Really a high level straight percentage. You know, my salary increased 20%, my benefits increased 20%. Or getting more granular and specifically identifying those incremental expenses. We'll get into these examples here at the bottom here. So let's talk through a bonus payment. With the bonus payment, it's likely going to be one or the other. Maybe you gave out a 5% bonus because of retention, therefore your benefits are going to increase as well. You could do an equivalent of a 5% increase in that benefits expense, but likely with a bonus, things such as like a health insurance expense that is going to be in that benefits expense line wouldn't have increased that 5%. So that's going to bump you into that specifically identifying incremental expenses where you likely are going to pull out your bonus amount and then pull out those applicable taxes. Maybe there is an additional contribution then to a retirement plan, but maybe you're going to make it at that more granular level. With the allocation of salaries, this is going to be, you can do it maybe a high level of, you know, John, the CEO, spent 10% of his time on preparing to or responding to COVID-19. Therefore, we're going to allocate 10% of his benefits and salary expense to the Provider Relief Funds. Really, you could also go more granular, where maybe he attended 3 one-hour meetings in a week, 1 week, and the next week he only had 2 hours of time. Again, you're pulling out those specific, then that more detailed or incremental expense for that allocation. There is no clear guidance out there, similar to the other topics, where HHS has come out and said, you need to do this calculation in this manner. Just make sure that your facility is comfortable with whatever method you are selecting, and make sure you have that documentation retained, which of course I will touch on here again. This slide here are additional things that we kind of just put together to maybe spark some ideas to make sure that you can really utilize all of this money that you have received. So consider greeters and screeners. I think most facilities have put greeters and screeners at their front doors, whether those were new hires where you had additional positions, or whether you were allocating some employees that were working maybe simply at front desk, but they're spending the majority of their time now screening, taking temperatures and things like that. So taking a look at that, allocating that to applicable time then to the Provider Relief Funds. Extra pay for open shifts. We've seen shift differentials being paid. We've seen the incentive of, we will pay you, $500 if you take these Saturdays that we need, whatever it may be. But we are seeing that there are additional payments that facilities are making to make sure that they have extra coverage that is needed here. Individuals that are out on quarantine. This is a new thing that's popped up, is not only is there sick time or vacation time, you may have offered a bank of quarantine time. So keep in mind though that if you have an accrual out there, or maybe employees get 2 weeks of quarantine accrued, you cannot submit that accrual to Provider Relief. But if you have expensed some of that, if individuals have used some of that time, the time utilized could be allocated. So keep in mind, you can't just book an accrual and use that. It would have to be that expense time. Staffing increases, similar to the other topics, if you gave kind of that retention incentive, if you had to bring in additional staff, these are all eligible to be reimbursed. So take a look at that. Additional expenses, this would be things like the daycare expenses, like the housing expenses. Maybe you're now offering free meals to your employees so they don't have to leave the facility and come back in. Those could all be eligible to be expensed or allocated there. So my last reminder here at the very bottom, I think something that gets overlooked here with salaries is that not only are they going to be reimbursed from a PPP, state grant, SHIP grant, things like that, but you could be billing for some of this time, because some of it could be your nursing or physician time. If you were billing for this and getting paid from a third-party payer, your insurers, your Medicare, Medicaid, that needs to be offset in this expense as well. So don't overlook that piece of it. It is an extra step, but just want to make sure that you're considering it with these amounts. Last one, this has been hit on several times, but this one especially, you're gonna have a lot of ins and outs, especially if you're doing it at that detail level, tracking meetings, tracking the number of screeners, visitors, things like that. Keep your documentation in order, and I would recommend getting that in order now. You're going to know those expenses now as you go through that, do those calculations, review that detail on those invoices. So pull that together now, have that documentation that says this was a new expense. We needed to do this to retain our employees, whatever it may be, and document that now. If you get selected for an audit a year or two from now, trying to hunt down what $50,000 of salary expense was for may be tricky. So make sure you have that and retain that. And with that, I am going to kick it back to Ashley so she can give us a good conclusion here.
All right, so before I jump into some of the next steps, what is it that you can be considering now? Because as you've heard, of course, from the team, a lot of uncertainty out there, unfortunately, still, even though we are certainly pushing up on that June 30th deadline. But one of the things I wanted to touch on, because I know there are a few questions that came through on this, and we hear a lot of other questions as well, is regarding how does my other assistance received play into all of this? And so the primary one, of course, being PPP loans. I know a lot of you out there received PPP loans as well, in addition to the provider relief funds. But this could also be other assistance received. Like I know someone had mentioned in the chat a question about, receiving different COVID grants, things like that. So essentially back last fall, HHS had issued a frequently asked question in which they said that if you have any other assistance received, including PPP loans, you need to offset your lost revenue by that amount, which of course, I mean, that's huge. Those PPP loans, of course, are a significant dollar amount for a lot of you. And so, that was really looking like it was going to have a very negative impact on those lost revenue calculations. So fast forward to January when the new reporting guidelines came out, HHS did a couple of things. So first of all, you still have to report your other assistance received, but instead of having it within the lost revenue section of the reporting guidelines, they actually moved it out to just another section at the end, which we thought, okay, that's really interesting. They took it out of the lost revenue section. Right around this same time, HHS actually went out onto their website and they removed that initial frequently asked question that said that the other assistance received needs to be offset. So while they unfortunately have not just come out and said, you don't need to offset this, you can just calculate your lost revenue and just report other assistance to us, they unfortunately haven't been that clear, but these changes do give us some hope that they are not going to require those amounts to be offset. So hopefully more to come. I know that's one of the big questions that the AICPA has submitted over to HHS as well and is waiting for an answer on, because it of course has some very significant impacts. But overall, okay, what is it that you can do now given this period of uncertainty? And so I think the first thing, just starting off, is look at your lost revenue and really evaluate what are some of those different scenarios. And so as Braid mentioned when he went through the lost revenue area, you do have a few different options. And of course, first off is comparing that comparison to actual and that comparison to budget. If you have a budget that was approved prior to March 27th of 2020, those are going to be really your most straightforward options. So if one of those works for you and you do have lost revenue that you can show, that is great. But if that's not going to work out, certainly start thinking through those different types of alternative methodologies and determining if something would make sense there. In addition to your lost revenue, start accumulating those expenses that are attributable to coronavirus, including any capital purchases. And so what I always tell everyone is, I know it was really tough, especially as the pandemic was raging and you're really just trying to, take care of patients and keep things moving. But, stepping back maybe to take a look and say, really, what was it that we changed as part of our processes? What did we have to do differently? What other purchases did we have? And so really start thinking through those things and really, start accumulating a list of those if you haven't already. Definitely don't forget that amounts reimbursed by other sources though, especially what we're seeing for critical access hospitals. That is a huge amount. So fortunately makes those expenses that you have to come up with a bit higher, but something to think about. And then if you do have unspent funds, work with your leadership team to start developing some strategies. And I know we say that we're now on June 8th and you think, okay, we have 3 weeks here, what are we going to do? I think certainly looking ahead if there are some things that you can do prior to June 30th, but also being aware that that rumor of the extension is out there. So worst case scenario, you know, have some shorter term things in mind, but maybe be thinking, okay, worst case, if we haven't spent all of our funds, but this does get extended, is there something else that we would want to utilize these funds for? And then, as has been mentioned multiple times, retaining that appropriate supporting documentation is going to be so key with this. So as you're going through and compiling items, just making sure that you're thinking, okay, if I was to be audited, whether requiring a single audit or having an audit done by HHS, really, what would I need to show them, and getting that information together. Also be thinking ahead to, you know, are there some additional funding opportunities that we would want to pursue? First one is there are some additional provider relief fund phases that we know are out there, as I previously mentioned. So what we do know about those now, application periods have not been open, but we do know that they are going to be based on your financial results for the fourth quarter of 2020 and the first quarter of 2021. So they're going to be looking at something during that time period, and that's what it's going to be based on. So if you are interested in more provider relief funds, certainly keep that in mind and be looking out for that. We've also just listed a number of others here that are coming down the pipeline, several of them related to rural health clinics. And so if you do have rural health clinics and are looking for more funding, take a look at that. And then specifically wanted to mention the Small Rural Hospital Improvement Program. So that's one that will go primarily to critical access and other rural hospitals. If you are interested in that, you'll want to reach out to your state's SHIP grantee, so often your Office of Rural Health, but certainly some different funding opportunities that you can take a look at. All right, and so that's what we have for the rest for our overall presentation. And so now I guess we can take a look. I've been trying to hit most of the questions as they come through the Q&A, but I know there's maybe a few others out there. We'll go ahead here and just take a look. I think we're probably covering a lot of these. I know someone had asked the question that if you received more money than your qualifying expenses, what is the deadline for paying back that money, and how do you pay back that money? And so essentially at this point, they have not given definitive guidance on paying back that money, but HHS has said that they will provide some mechanism when this is all said and done to essentially allow you to pay that back. So certainly something to be watching out for. It will be after the deadline period, of course, and likely after the final reporting, whatever that final reporting ends up being. As of right now, the official final reporting date is still set at July 31st, but highly unlikely that that's going to stay, considering that the first reporting deadline has not even happened yet. So next question I see here is someone said, are salaries for employed physicians, do they have to be reduced to that same executive level 2 amount as well? And I would say yes for that. Certainly that they're looking really at any salaries. So I would include the physician piece in there as well. All right. Someone, again, common question that we get here, there was a question about multiple employee retention payments and if those are acceptable. And so really the guidance that's out there on the employee retention payments is really just that frequently asked question that Molly had gone through. Unfortunately, we don't have a lot of additional guidance above and beyond that. And so I think it's certainly something to look at there. Is it something that is reasonable and would be within the normal course of your business? So I think it would be certainly, it's been a very long pandemic period, I guess. So I think to certainly say that there would be multiple payments, I wouldn't say that that's absolutely something you couldn't do. But again, looking to just make sure that it's reasonable, reasonable compensation levels. And I think it looks here, Amanda, like we are approaching the top of the hour. If you'd like to go ahead and get us wrapped up.
Yes, absolutely. Thank you everyone for attending today. As a reminder, this presentation was recorded and will be posted later on this week to our YouTube page, along with a copy of today's presentation materials being emailed as part of our follow-up process. Thank you.
Yes, thank you. Thank you everyone for joining us today and for all of your great questions.